A corrupt government minister makes a series of large wire transfers in a matter of weeks, which totaled more than his entire annual salary, to an account held by an offshore shell company. A cybercriminal utilizes an online currency exchange to convert virtual currencies earned from ransomware attacks into US dollars and transfers the funds into an account he controls. A company involved in tax evasion conducts transactions to subsidiaries located in secrecy havens so it can move money overseas, illicitly concealing it from tax authorities. These examples are snapshots of varied financial crime schemes, but all feature something in common. Money laundering is an essential part of their process. In nearly any type of financial crime, there's almost always a link to money laundering. To be able to detect and prevent financial crime, it's therefore critical to understand the basics of money laundering, what it is and how it's conducted, as well as the fundamentals of a successful anti-money laundering, or AML, program. In simple terms, money laundering is actions or conduct designed to conceal the origin and ownership of illicit funds, money that was derived by illegal means, and is then moved or hidden to obscure the source. When many people think of money laundering, the first image that springs to mind is dirty cash being moved and deposited into a bank or other financial institution. This is certainly one common form that money laundering can take, and crimes like drug trafficking, arms dealing, or the sale of counterfeit goods typically generate large volumes of currency that must be stored, bundled, and moved into the financial system. But it's important to recognize that money laundering can take many different forms and exploit nearly any asset, financial service, or payment channel. Techniques to move and conceal illicit proceeds are only limited by the imagination and creativity of the financial criminal. In some jurisdictions, there's another form that money laundering can take: the movement of funds or assets tied to specified unlawful activities. This can include funds originally obtained legally, but that are subsequently being used to finance or perpetrate an illegal act. An example is fundraising by a charitable organization funneling proceeds to a terrorist organization. The charity is raising funds from donors who have obtained money through legal means. In some cases, donors may not even know their funds are being used to support terrorism. However, the movement of funds from the charity to the terrorist group would still be considered money laundering in many jurisdictions. Money laundering can overlap directly with other forms of financial crime. A fraudster could move funds collected from investors in the midst of a Ponzi scheme, using some portion of the proceeds to further the fraud and help recruit new victims. In this case, the transactions are both fraud and money laundering.
Following 9/11, I was actively engaged in the whole area of terrorist financing. And I can say that probably much like most police forces around the world, not a lot of us had really centered on what terrorist financing was and how prevalent it was. I can tell you that from the investigations that occurred working jointly with our U.S. counterparts, because it was in the Canadian law enforcement at the time, the Royal Canadian Mounted Police, we found that we had far more people that were prone to financing terrorism than we ever realized. That has still continued to exist with law enforcement agencies around the world having to follow dozens of individuals, sometimes up into the hundreds of individuals that have been possibly radicalized, believed to be a possible threat, believed to be financing terrorism. And that really is where it is so difficult today to take on terrorism. It's the amount of resources that it takes to follow them. It's the small amounts of money that is capable of being used for a terrorist event. It's not like a major criminal organization where it's millions of dollars. We can talk tens of thousands of dollars that will finance a terrorist event. So these things are difficult from a terrorist perspective. It's not going to go away. I said on 9/11 that the world changed on that date. I believe it did. I think what we're seeing around the world, really demonstrates that over and over again. So what it's going to require is more diligence on the part of everybody, not just law enforcement or the financial sector, but society as a whole, because it's not going away, and none of us want to be part and partial to a terrorist event because we looked the other way. And that's what the reality of terrorist financing is today.
Money launderers typically have three objectives: move the proceeds of crime away from the source, conceal their own connection to the proceeds, and eventually enjoy the use of the laundered proceeds. These objectives align with the stages of money laundering: placement, layering, and integration. The three stages are a useful way to conceptualize the flow of money laundering and frame cases for investigation. While you may not be called on to identify a specific stage of money laundering in a real-world setting, you should expect to see questions about the three stages on the CFCS exam. The first step, placement, is the entry of illicit funds into the legitimate financial system. Often this consists of physically turning over cash to a financial institution such as a bank or money services business. However, placement does not have to involve cash and can be conducted through non-traditional financial institutions or non-financial businesses. The primary goals of placement are to gain access to the financial system without detection and to obscure the criminal source of proceeds. Placement starts to distance funds and assets from their origin and often makes them more liquid and easily transferable. It's at this entry point that suspicious transactions are most easily detected. Criminals often use cash couriers, or smurfs, to make many deposits in various financial accounts. The deposits are structured in small amounts, below the threshold that must be reported. Cash might be converted right away into other financial instruments, such as traveler's checks, or into commodities and assets like precious metals, precious stones, or high-value luxury goods. Illicit funds could be laundered through a non-bank institution like a casino, or mingled with the legitimate proceeds of a cash-intensive front company such as a bar, restaurant, or retail store. Sometimes the criminal will enlist the help of a complicit banker or broker. A gatekeeper such as a lawyer, or in some countries a notary, can handle funds or move assets on behalf of clients and help get the proceeds into the system. Here's a slightly less traditional example of placement to illustrate the various channels that money laundering can take. This is a photo of a rebel group in Colombia known as FARC. For over 50 years they fought against the government and were considered a terrorist organization by some countries. To fund their activities, FARC became heavily involved in drug trafficking. Eventually they turned to illegal gold mining. They took over legitimate mines in remote regions of Colombia and ran them, with the result that they had financial assets in the form of gold, which they needed to get into the financial system. In Colombia, as in many other countries, dealers in precious metals and stones are treated as non-bank financial institutions and subject to AML regulations. FARC used stolen or fabricated identities, as well as real people under their control, to sell gold to wholesalers who in turn sold it to gold refineries in other countries. This was placement, although it occurred outside the banking system. FARC introduced an illicitly derived asset, gold, into the financial system through precious metal dealers. Once the funds are placed, financial criminals then move on to layering. The goal is to further separate criminal proceeds from their source through layers of transactions. Layering is intended to obscure the placement of funds into the financial system, make it more difficult to trace them, and disguise their ownership or control. One popular method is to wire the money from one account to another, repeating the process through the accounts of different associates or interconnected legal entities. Some might be shell companies owned or controlled by the criminal in different jurisdictions. These cross-border transactions muddy the audit trail and make the investigation more time-consuming and resource-intensive for law enforcement. Let's say there's a Ponzi schemer operating in South Florida, generating substantial revenue from his fraud. To conceal the illicit nature of his funds and increase the likelihood he can access them later, he moves the money through a series of transactions, from his own account to one controlled by a shell corporation, then to an account held by another shell company in the Cayman Islands, to a trust based in Ireland, then to the Seychelles, and so on. If his Ponzi scheme falls apart and investigators move in, they'll have a hard time tracing and recovering those assets. If they follow the money offshore, investigators will have to make a request to the Cayman Island authorities and law enforcement, get the information about the account, and comb through the records to figure out where the funds have gone. They have to repeat the process in Ireland, then again in the Seychelles. Unless this is a high-value fraud scheme with significant amounts of money at stake, at some point investigators might determine they lack the resources to pursue the case, or might run out of time before the proceeds are liquidated and the trail goes cold. The same thing happens in the private sector. If asset recovery specialists are asked to investigate and keep peeling back the layers of the onion with no end in sight, they may have to stop and simply hope law enforcement or the courts can follow up on the fraud. Creating these layers of transactions, especially through international funds transfers, is very beneficial to the financial criminal. Wire transfers are a popular, all-purpose method to conduct layering. Layers of transfers offer the advantages of speed, distance, and increased anonymity. Other techniques could involve purchasing multiple financial instruments, moving the money into a securities account, or buying and selling stocks, bonds, or derivatives. Another option is through round-tripping. This could involve paying funds into a lawyer's trust account as a retainer, then getting the same amount back later as a purported settlement. Another example of round-tripping is when a company sells an asset to another company, agreeing to buy back the same asset or a similar one at about the same price. Typically, these companies are owned or controlled by the same person or their associates. The more complex and numerous the layers, the more difficult it is to trace funds, establish their ownership, determine their ultimate destination, and recover the assets. The final stage, integration, puts laundered funds back into the economy with the appearance of coming from a legitimate source. This allows criminals to use, enjoy, or store the proceeds. At this point, an investigator would need intensive forensic accounting to go back through all the layers of transactions. Undercover agents or informants might be required in order to expose the entire scheme. Shrewd money launderers use some of the same techniques for both layering and integration. These include real estate transactions, bearer shares, trusts, limited liability companies, nominee ownership, or international trade partners. Funds coming from an attorney's escrow account as a settlement of litigation would seem fairly above board. A payment from a securities broker as the proceeds of a sale might look entirely legitimate. Repayment of a loan from a business associate could appear as a normal activity. All of these can be forms of integration, and at this final stage, it's even more difficult to distinguish between legitimate and illegitimate funds. Real estate investments are a very common method of integration, a safe and easy way to park assets. With millions of dollars, a criminal can buy luxury condos in cities with high-end property markets, such as Vancouver, New York, Miami, or London. That's better than having the money pile up in cash or sit in a potentially unstable country like Venezuela, where it's at risk of seizure or having the account shut down. Financial criminals look for stable, safe real estate markets as places to store large amounts of value, often holding properties in the name of shell companies, other legal entities, or front buyers. Transparency International recently reported how shell companies and nominees in Canada are being used to conceal the true owners of real estate. In one notable case in Vancouver, a university student purchased a property for $31 million. The true beneficial owner was unknown. For another less traditional example of integration, let's examine the case of Miguel Trevino Morales, a high-ranking member of a Mexican drug cartel called Los Zetas. Along with helping to direct the cartel's trafficking operations, Miguel and his brother were huge fans of quarter horse racing, a popular sport throughout the American Southwest and northern Mexico, with lucrative prizes for winners in some races. The Trevino brothers would use profits from their drug trafficking to have friends and associates buy horses at auction, often making the purchases under fake names, or if possible, giving no name at all. They maintained ranches in Texas and other states, all fueled by illicit proceeds. For a long time, the money laundering operation went undetected because the horse racing business was so successful. Their horses won high-stakes races, and some of the champions were worth more than $1 million. To the casual observer, the Treviños appeared to be nothing more than savvy ranchers and horse breeders. U.S. authorities investigating the Zetas cartel eventually discovered the Treviños' activities. They arrested Miguel's brother and shut down their operation. This case illustrates one of the many avenues available to financial criminals to move illicit proceeds, conceal their origin by purchasing assets, then integrate the funds in a way that, on the surface, appears legitimate. The challenges of detecting money laundering in the integration phase demonstrate a key fact. It's better to prevent illicit funds from getting into the financial system in the first place than chase them afterwards. Preventive measures at financial institutions are therefore critical, and these form the heart of anti-money laundering programs.
When money laundering was first discussed by international bodies in the late 1980s, the predicate crime was drugs. For instance, in the United Nations Treaty on Psychotropic Drugs, they discussed money laundering, but only as it related to drugs. However, as money laundering has evolved, there is growing perception in key jurisdictions that financial crimes are the most rapidly growing category of predicate crimes. Most common financial crimes are fraud, money laundering, cybercrime, terrorist financing, bribery and corruption, market abuse and insider dealing, and information security. Unfortunately, the red flags or indicators of financial crimes are often difficult to detect because the indicators may also represent legitimate financial activity. One of the best examples of this is a Ponzi scheme. I've been involved in several cases involving Ponzi schemes where the customer of the bank had an account with the bank for many years and conducted hundreds of thousands of legitimate financial transactions before the fraudulent activity began. It's very unusual for a financial institution to know when its customers are committing fraud against their own customers. Because, as an example in the Ponzi scheme, it's a fraudulent investment scheme. It often looks from a bank perspective that transactions are legitimate investor activity. Another example of this is when an import-export company may be involved in commercial fraud. But again, it would be very difficult for a financial institution to detect that fraud. This is why enhanced due diligence, both in transaction monitoring and updating customers' profiles, is critical. So whether your customer is an investor, an importer, an exporter, a construction company, you must always be looking for anomalies, which may be indicators of financial crimes being perpetrated by those customers. For example, if there are increased or decreased deposits or withdrawal patterns, visit the customer and determine the cause. When in doubt, ask for an explanation and file a suspicious activity report if necessary.
There are no definitive rules on what constitutes suspicious activity related to money laundering. Most red flags are situation-specific, so it's not necessary or practical to memorize lists of red flags to cover all circumstances. Institutions should develop their own lists of suspicious indicators based on their products, services, geographic areas, and customer base. The best strategy is to look for transactions that don't match the expected activity of an individual or a business. In other words, behavior that simply doesn't make sense. Does this transaction fit with the customer's profile, history, industry, or peer group? In some CFCS exam questions, you'll be given details about the customer's transactions, their behavior, and some demographic characteristics. You can create a miniature customer profile with this information, and then use what you know about their peer group to ask yourself if their behavior makes sense, if it fits into the category of normal business activity. Good KYC practices, customer due diligence programs, and ongoing monitoring are all essential tools for the detection of money laundering. While there is no one list of red flags that can capture the full range of money laundering risks, there are known typologies of transactions and other activities that serve as common indicators. The most obvious is activity that is inconsistent with the customer's profile, outside the realm of what's normal or expected for this person. The next is an account that appears to be operated by a third party, when somebody besides the account signatory seems to be controlling the account in some way. Perhaps another person always accompanies the account holder when they come into the branch to conduct transactions, or funds are often wired into the account by an unknown third party. Funds transferred to and from known secrecy havens may be suspicious. Simply moving money out of the country is not necessarily a red flag if it fits the customer's normal activity and there's a reason for these transactions. However, if there's no rationale, no compelling business or personal reason for the transfer, this warrants close examination. If there are several large cash transactions within a short time, either deposits or withdrawals, there should be some reason or explanation for the activity. Multiple deposits to the same account by different people or several transactions on the same day from different locations could indicate the account is being used to funnel transactions as part of a financial crime scheme. A large number of ATM deposits might represent proceeds of illicit activity, such as drug trafficking. It might also be connected to human trafficking, people being held for forced labor, with any money they make taken away from them and deposited via ATM into a funnel account. The same home address used for funds transfers to different persons can indicate schemes like tax fraud. A perpetrator could file for a number of tax refunds using stolen or fake identities, and use the same address to collect the refunds. Financial criminals often know a great deal about the laws they're violating, including the reporting limits for different types of transactions. That's why they may structure their transactions just below the reporting threshold. Many other examples of red flags are provided in the CFCS study manual. It's important to remember that red flags are customer and situation specific, and something that's suspicious for one customer may be completely normal for another. By maintaining a flexible and skeptical mindset, you will be better placed to detect and prevent financial crime. For decades, financial institutions around the world have focused on offering services, products, and cross-border connections to make moving funds, storing value, and making payments globally a fast and convenient process. All types of financial institutions are vulnerable to money laundering schemes at various stages. However, some services and products are generally recognized as higher risk. A correspondent account is an account that's held by one financial institution for another financial institution, often in another country. Correspondent banking services can also be provided domestically, but these generally pose lower risk. Some foreign financial institutions are subject to regulatory guidelines that are not as strict as those that govern domestic banks, so they pose a higher risk for money laundering. Foreign correspondent accounts are often used by drug traffickers, tax evaders, or other criminal elements to move illicit proceeds into or out of a country. Correspondent accounts can be difficult to monitor due to the high volume of transactions moving through them. The domestic bank that holds the account may not be familiar with the customers of the foreign correspondent institution. They may not know what constitutes normal activity or who has access to the account on the other end. Let's suppose you work for a bank in France, and you're setting up a correspondent account for a bank in Mexico. You've done your due diligence on the Mexican bank with positive results. They seem to have a robust compliance program and have provided the necessary documentation. You didn't find any enforcement actions in a negative news screening. Your bank opens the account and allows the Mexican institution to begin conducting transactions. What you don't know is that they're giving unlicensed Mexican currency dealers access to this correspondent account so they can move funds and clear transactions in euros. Now there's a very risky set of transactions moving through the account. If your financial institution in France doesn't implement proper monitoring and investigation, these may go undetected. A real case from several years ago illustrates this risk. Brown Brothers Harriman, a big investment bank in the U.S., was penalized by U.S. regulators for a variety of AML weaknesses. One point noted in the enforcement order was that Brown Brothers Harriman held correspondent accounts for Swiss private banks and was not monitoring them closely enough. The Swiss financial institutions were allowing U.S. tax evaders to move money to and from the U.S. through their correspondent accounts. Brown Brothers Harriman was unaware of the nature of these transactions and failed to spot the suspicious use of these accounts. Private banking is another service that historically has carried a good deal of risk. Private bankers provide personalized services to high net worth customers. Each account is directly overseen by a relationship manager, and the services can include such activities as estate planning, financial advice, lending, investment management, bill paying, mail forwarding, and property maintenance. Clients of private banks are often wealthy and powerful individuals who place a premium on discretion and anonymity. In some cases, relationship managers put their clients' interests ahead of compliance. They may fail to conduct due diligence or report suspicious activity. Some will run interference for clients or even assist them with illicit transactions. Private banking is a competitive field that offers potential for significant profit. Some private banking operations have developed a culture of confidentiality and lax internal controls. This creates pressure to keep existing clients and gain new ones, even when it conflicts with AML compliance. In some instances, the compliance department has been stonewalled or ignored, and the financial institution has enabled tax evasion, corruption, and the movement of illicit funds. In addition, in the private banking world, there's greater likelihood of dealings with politically exposed persons. PEPs are government officials as well as their family members and business associates, and there are risks of financial crime such as corruption or tax evasion associated with providing them with financial services. There are many instances of PEPs using private banking services to conceal illicit transactions or move proceeds out of their home country.
International private banking is high risk for money laundering. In this case, an international banker at Bank One solicited a $2 million deposit out of the Mexico branch. The money was deposited in New York and remained there without due diligence done on the customer directly. Rules of the bank require that before a foreign customer could be established, the person had to be met with in person, with one exception. If they came with a high level, what they called verified recommendation. This banker said he had that recommendation, though as we will see, there was nothing in the files to document that. So the money sits there as a $2 million deposit, and the banker goes about soliciting other customers. Banker gets a better offer from Bank Two and leaves there. He takes with him this $2 million private banking customer. He informs Bank Two that he's done all of the verification required on this customer and that they should feel comfortable with the account. They take his word for it. The account grows. It goes from 2 to 5 to 17. The bank is happy in one sense that they have additional monies on deposit, but they begin asking, what is the source of funds of this client? There's no easy answer to that. The banker says he's in the ranching business and he owns gas stations, petrol stations in Mexico. The bank takes his word for it, though interestingly, in the account opening cards, which reflect that the banker and the customer were together when the account was opened at Bank Two, the diary of the banker shows later that he was not in the same location as the customer on the day that these cards purportedly were signed. A red flag is raised. The money sits and, as in many cases, remains dormant to ratchet down the level of interest in an account that moves up quickly in volume when it hadn't been moving quickly previously. The banker then is asked by the customer to begin sending multiple wire transfers out of this account. The $17 million is then dissipated into various locations just about the time that the bank receives a subpoena from law enforcement to freeze these accounts. Unfortunately, the subpoena arrives a day late and the accounts are gone, but the bank now is held liable for the acts of their banker who failed to take due diligence steps to know their customer and his source of funds, which resulted in ultimately a problem for the individual banker and a very big problem for the bank. Proving once again that knowing your customer, identifying your customer properly, monitoring their transactional activity to make sure that it's consistent with who they are is an important component to success in the field of compliance.
Securities broker-dealers can be utilized in any number of financial crime schemes. The fraud section will describe this in more detail. One risk for the broker-dealer is that they can be used to launder money, sometimes complicitly, but more commonly without their knowledge, especially as part of the layering process. The financial criminal might invest in different securities, hold them for a period of time, then cash out and withdraw the funds. This makes it appear legitimate since the money is coming from a securities account and appears to be proceeds of the sale of securities. Another layering technique is wash trading, or buying and selling the same set of securities back and forth between two accounts owned and controlled by the same person or their associates. The purpose is not to make money from the sales, but to create layers of transactions. A complicit dealer might also facilitate money laundering in the placement stage by accepting illicit proceeds into a nominee account.
Securities industry is a little bit different. When we talk about money laundering, we often talk about placement, layering, and integration. And as a general rule, you're not going to see placement in the securities industry because most securities firms don't take cash. Securities firms are often where you'll see layering. People will move things from one place to another, run it through their brokerage account in order to do the layering piece of money laundering. However, in securities, you will also see sometimes the actual crime occurs within the account itself. And what I mean by that is securities fraud. So securities fraud is going to happen, of course, in a securities account. And there's a couple different things that we see. We do see insider trading, which is when we trade on non-publicly available information. So let's say that I'm a client and I am the one who knows the CEO of a company, and that CEO tells me that they're about to make a big acquisition, or maybe their financials didn't do so well this year. So I'm going to act on that information because I'm friends with that CEO, but the general public doesn't know that information yet. That's insider trading. We do typically see that in thinly traded securities. You're not going to see it often in the big companies. A lot of times it's those small startup companies where either the client or the advisor develop a really close relationship with the owner of that company, and insider trading can occur. The other type of securities fraud that we often see in accounts involves market manipulation. And one of the most common schemes are those pump and dump schemes that you've heard about. So what happens is these small stocks come in, they're not worth a lot of money, they're worth maybe 3 or 4 cents a share, maybe more, but they tend to be thinly traded, and then somewhere along the way, someone will start promoting that. A lot of times you'll have promoters in this space who want the cost of that stock to go up. So they create a demand, and people start buying a lot of that stock, and it moves from maybe 4 cents a share to 5 or 6 or maybe 7 cents a share. And when you own 10 million shares, that 3-cent difference is a lot of money. So what they're doing is they're creating a false market for these particular stocks in order to pump up the price. The people who know that information turn around and sell it, and now everybody who bought those shares have worthless shares. So that's a pump and dump scheme and another type of market manipulation that we will see inside of a securities account. So the crime is actually the securities fraud that happens in that account. And when they start moving that money, whether it's within the account, another account, outside of that particular account, that's where the money laundering occurs, because now they're trying to hide the original proceeds from that crime.
The insurance industry is typically a lower risk for money laundering, with the exception of certain products. If a policy has a cash surrender value, money launderers could purchase it as part of a layering scheme. For example, a launderer could buy a $100,000 life insurance policy with a cash surrender clause, then cancel it, pay a penalty, and get some portion of the proceeds back as a seemingly legitimate refund. Another method is to overpay premiums in order to get a refund, again for the purpose of concealing funds and making the source look legitimate. Insurance dealers are also at risk of being defrauded in numerous financial crime schemes. There's a variety of risks associated with the real estate field, and financial criminals use property to park assets and integrate funds during money laundering. Real estate agents, brokers, attorneys, and title insurance providers can all be involved. In many jurisdictions, real estate service providers are not subject to AML reporting and customer due diligence requirements, or are covered by less stringent regulations. Some real estate transactions are conducted in cash without loan financing from a bank or other financial institution. In many jurisdictions, transferring ownership of a property is a relatively simple matter. This means that purchases can be conducted by a front man or a front company before the property is turned over to the beneficial owner. Combined with the use of shell companies to purchase and hold properties, this creates an attractive loophole for financial criminals. Recently, the U.S. Financial Crimes Enforcement Network, or FinCEN, took aim at illicit proceeds in real estate through geographic targeting orders. These require the reporting of cash transactions over a certain threshold by industries outside of the traditionally regulated financial institutions. FinCEN targeted title loan insurance providers in New York, Miami, Los Angeles, San Francisco, and parts of Texas, requiring them to report cash transactions over certain thresholds in an effort to detect suspicious property purchases and sales. Other nations are taking similar measures to clamp down on illicit proceeds moving through real estate. Precious metal dealers came up in the context of the FARC case, but there's a whole variety of ways in which they can be utilized in money laundering schemes. Gold, silver, and precious stones represent high-value assets that usually retain their worth over time and can be easier to transport than large volumes of currency. In many jurisdictions, it's common to buy and sell these assets in cash. They're better than currency for holding their value across national borders, and this makes them useful for smuggling illicit proceeds from one country to another. Also, many people convert assets to gold or precious stones in order to evade sanctions. For example, associates of the Iranian government have used couriers to fly gold to Dubai, sell it in US dollars or euros, deposit the proceeds of the sale into an account, then move it to other financial institutions. This is a way for sanctioned entities to get money into the financial system if they're blockaded from traditional access. Casinos are most popular at the placement stage, depositing money into the financial system or moving money across borders. For example, high rollers, or high net worth individuals, have been known to wire money from a financial institution in China into an account in Las Vegas, use the funds to gamble, then cash out and deposit the check from the casino into a U.S. financial institution. This provides access to the U.S. financial system and, by extension, the world. The money could be the proceeds of corruption or fraud, but because they moved it through the casino, they've received what appears to be legitimate winnings. Casinos and gaming companies share the same vulnerabilities as other cash-intensive businesses. Many of their customers use currency to establish a gambling account or purchase betting products, but it can be difficult for the gaming company to understand the source and origins of this cash. Gaming institutions can also be co-opted by organized crime rings for use in money laundering operations. In some jurisdictions, they don't have very rigorous procedures for customer due diligence or transaction monitoring, and may not be subject to the same AML regulations as other financial institutions. In the U.S., FinCEN has brought major enforcement actions with substantial penalties against several casinos and gaming outfits. As a result, many casinos have boosted their efforts to understand the source of customers' funds and monitor their transactions. Gatekeepers are under more regulatory scrutiny lately. These are people who can assist clients to access the financial system or help them conceal beneficial ownership. For example, creating a company or a trust can involve an attorney, an accountant, a notary, an incorporation specialist, and an asset management firm. Gatekeepers in these roles might accept funds or hold assets and help to set up a legal entity, and are vulnerable to being used as part of a financial crime scheme. The concept of beneficial ownership is an essential part of financial crime detection and prevention. A beneficial owner is a person who ultimately controls or benefits from funds, assets, legal entities, or financial accounts. It's important to understand the process of setting up an entity to conceal beneficial ownership. You'll need to know terms such as shelf corporation in order to understand scenarios presented on the CFCS exam and differentiate the correct and incorrect answers. The goal of the financial criminal is to benefit from an asset or to store and control it without having their name attached to it. In order to do this, the criminal has to conceal their beneficial ownership and avoid having it traced back to them. Trusts are one of the preferred vehicles exploited by financial criminals. In simple terms, this is a legal arrangement in which a person, called the settlor, transfers assets into the control of a trustee, often a lawyer, to be held in trust and managed for the benefit of another person or persons, called the beneficiaries. The vast majority of trusts are legitimate, and most are designed for wealth management, legal tax reduction, or other above-board purposes. Financial criminals are able to use them to cover their tracks because many jurisdictions allow for secrecy in the structure and ownership of trusts. While the trustee may be identifiable, the settlor and beneficiaries can be anonymous. In some cases, there might be a legitimate reason for privacy, but the attraction for financial criminals is obvious. They can create a trust and put assets into it, hiding behind a lawyer who is either crooked or simply unaware, then dictate what happens to the assets in the trust without having their name attached to it. Trusts can also be used to hold corporations and other legal entities, creating an additional layer of concealment for criminals. Shell companies are one of the more notorious and consistent fixtures of financial crime schemes. These companies exist only on paper, don't have any employees or physical operations, and usually don't conduct any independent business. There are many countries and jurisdictions around the world that allow for the quick and easy formation of shell companies by citizens or non-residents. Some have an entire ecosystem of service providers, professional registered agents, company formation services, attorneys, and others that can help clients establish a shell company within a matter of days or even hours. There are legitimate reasons to form a shell company, for example, to optimize taxes or protect against legal issues. In the U.S., many businesses have an LLC, or limited liability company, based in Delaware to protect themselves from certain liabilities, and is completely legal. However, shell companies are also an essential smokescreen for financial criminals, who use them to open accounts, hold real estate, obtain loans, and transfer assets to other entities. In most jurisdictions, a person can form a shell company without disclosing its beneficial owner. Incorporation documents usually require the designation of a company agent and often a listing of directors or members. However, these can be service providers like registered agents or nominee directors, leaving the true owners unknown. Offshore secrecy havens are not the only choice for the formation of anonymous shell companies. Several U.S. states, such as Delaware, Nevada, and Wyoming, are also popular. In fact, the Financial Action Task Force has sharply criticized the U.S. for these weaknesses in its beneficial ownership framework. A shelf company, in the simplest terms, is an old shell company, a corporation that was formed a while ago and left on the shelf to age for several years. It may have been active at one time but then became dormant and is now being sold or transferred to another owner. There are legitimate reasons for purchasing and using a shelf company. For example, some jurisdictions have regulations that prohibit international investments in a company unless it's been in business for a certain number of years. Someone wanting to move money into the country could purchase a shelf company that meets these requirements from an incorporation provider. Obviously, there are illicit uses for this as well. A criminal might want to take advantage of the superficial legitimacy of a shelf company with years of history. A financial institution is likely to be suspicious of a company that has only been in existence for a few weeks and could be reluctant to open an account or conduct large transactions. They would require more detailed information from a new company about its owners, origins, and source of funds. However, if the institution searches a corporate registry and discovers that the company was formed 10 years ago, the prospective customer now seems more legitimate, at least on initial inspection. The financial institution needs to dig deeper to determine the beneficial owner. If the company is owned by a group of investors, the account manager will need to be satisfied that the parties are legitimate. If the owners of the company can't be identified, or if the reported reason for opening the account doesn't make sense, the financial institution might have to reject the business. Private investment corporations are another type of legal entity. They can be used to make investments or store assets under the control of the corporation. An individual or small group might create a private investment company and then move securities, properties, and other assets into it, where they can be held by the corporation without the beneficial owner's name attached. These have legitimate uses such as tax benefits and estate planning, but for financial criminals they can provide a degree of anonymity and confidentiality. Nonprofits, charities, and foundations play a role in a variety of financial crime schemes, especially those related to terrorist financing and corruption. In many jurisdictions, little or no information is collected on the true owners behind these entities. Some use registered agents or nominee directors. Particularly in the case of foundations, the founder or beneficial owner may not be listed in a corporate registry available to the public. Nonprofits and charities, due to their structure and legal restrictions, are more often used to move funds than to store assets. Many corruption schemes make use of charitable contributions as a cover for bribe payments. Terrorist financiers sometimes use nonprofits, charities, and foundations to raise money or conceal transactions. Although some donors knowingly support terrorist causes, others might unwittingly give funds in the belief they will be used for charitable purposes. Financial institutions have to carefully scrutinize charities, nonprofits, and foundations that operate in regions where there is a high risk of terrorist financing. Fronts and nominees act as the face of an account, asset, or legal entity, but they do not benefit from it. A front person could open an account and have their name attached to it, but another party truly controls it and directs transactions. A front company is one that appears to be legitimate, but is in fact a vehicle for holding or moving illicit proceeds. Cash-intensive businesses like bars, restaurants, and privately owned ATMs are popular fronts due to their ability to accept and conceal currency. A nominee is someone who is named on an account or entity but doesn't actually control it. A shell company could have nominee directors or service providers whose main function is to simply have their name listed in incorporation documents and carry out basic administrative duties. There are legitimate purposes for nominee accounts. They're common in securities trading, where broker-dealers hold nominee accounts for trading and investing on behalf of their customers. Bearer bonds or shares are a type of security that is owned or controlled by whoever physically holds them. They no longer exist in most jurisdictions, but in the limited number of countries that allow them, bearer bonds are an attractive vehicle to store value and conceal ownership. They're highly portable, and there's no registry to track who owns them. A financial criminal can purchase bearer bonds and give them to a corrupt attorney to put in a safe deposit box. If there's an investigation, the attorney is for all intents and purposes the owner. Someone could control a company by holding the majority of its bearer shares and transfer ownership simply by handing over the shares to another person.
Several years ago, an advocacy group in London organized a bus trip, and it was a little bit unconventional tour of the city. The tour that it took was not a tour of London's favorite sites. It was a tour of largely unoccupied luxury condominiums. And these condominiums were owned, or at least allegedly owned, by Russian kleptocrats, former Ukrainian officials that had moved assets out of the country in the wake of being ousted, allegedly some corrupt individuals, fraudsters, so on and so forth. Now, the reason they were allegedly owned was because the true ownership was obscured behind shell companies. These properties were multi-million-dollar, extremely expensive condos purchased in the names of corporations. This is very common in the UK. It's very common around the world. And it's one of the reasons why, in recent years, there has been an intensive focus on the subject of beneficial ownership. The concept of beneficial ownership is fairly simple. It embodies the idea that the name on a property, on an account, is not necessarily the person that benefits from it. Who truly controls it, who truly enjoys it, that's the true owner or the beneficial owner of the account, the funds, the asset. Beneficial ownership is a critical concept in financial crime detection and prevention, and lately it has been a serious issue in the regulatory space. We have seen in the United States new regulations requiring financial institutions, for the first time actually, to identify the beneficial owners of legal entities, new accounts opened by legal entities at the institution. In the European Union, the 4th and 5th AML directives require that as well. They actually require a deeper dive into beneficial ownership if there's a risk of money laundering or terrorist financing. 25% ownership is the standard, 10% on a risk basis, depending on if you believe the customer to be at risk for financial crime. Many institutions have adopted a 10% standard as the default simply to protect against risk. There are still plenty of jurisdictions that allow for essentially anonymous company formation, disguising the beneficial ownership behind this company that typically exists only on paper. The United States is one of them. Many U.S. states are gaining a reputation or have already gained a reputation as tax and secrecy havens as a result of this. And recently, the European Union published a report that warned the United States is actually at risk of becoming an increasingly attractive destination for foreign money coming in to evade taxes or otherwise dodge the law enforcement of their jurisdictions. So it's certainly not just a problem in some far-flung locale in the Pacific. It's a problem in Canada. It's a problem in the United States. It's a problem in every developed economy. There have been efforts towards a solution. The European Union has developed a system of corporate registries that will require, for the first time, companies to disclose beneficial ownership at the time of formation, stored and made available to institutions with AML compliance obligations. This is a big evolution in the space. It will provide a source of information on beneficial ownership that never existed previously. And it's another example of the gradual move away from a financial system that allowed for secrecy and allowed for anonymity to a system that focuses primarily on transparency.
Special purpose vehicles or entities can be used to conceal or contain financial risks, and can also be used to conceal debt. An example of a legitimate use is a company that wants to drill experimental new oil wells in the Antarctic. It's never been done before, and it could be a big financial risk, so the company is bringing in partners. In order to contain the risk, they form a special purpose entity. However, they can also be misused in fraudulent accounting schemes. Enron used special purpose vehicles to keep debt off the company's balance sheet. On the surface, Enron seemed to be in good financial condition, but underneath they were hiding their losses in special purpose entities. Eventually, it all fell apart. A holding company is a type of legal entity that exists to hold other legal entities and otherwise does not conduct operations of its own. Holding companies can often be found at the apex of complex corporate structures, owning a range of corporations and trusts. For the financial criminal, a holding company can provide an additional layer of concealment. You need to have a working knowledge of a whole range of financial service providers, such as money services businesses, securities broker-dealers, and asset managers. The exam is scenario-based, and you may be asked to step into the shoes of individuals at various types of financial institutions.
Let's say that I have an account in the United States, and it's named the John Smith account. So John Smith is the owner of the account. He now sends it to another country, whatever country that may be outside of the United States. Well, now it's outside the jurisdiction of the U.S., so it's really hard to track when it leaves the country. And it might be the John Smith account someplace else. And then he might have a different account where it's the John Smith and Mary Smith account, but he's hiding it because he's going across different jurisdictions and across the world. But they don't always have to leave the country. A lot of times it's a lot easier to leave it within the United States if that's where they are, or within Canada, or within the UK, because then they don't have to worry about it crossing all of these different borders, there being any kind of tax implications or anything like that. So they'll keep it in one country. I'll use the United States as an example, and we'll still talk about John Smith. So John Smith has an account, and it's a banking account, and he has this money from his illegal activity in that banking account. The next place that he sends it is to another bank within the United States, but it's no longer John Smith. It's the Smith Partnership, LLC. And then he sends that money to the Jones and Barker Trust. Well, who's John Smith? John Smith actually owns that trust. You just can't find his name. So he can move it through all of these different names when he's truly the beneficial owner. The other thing that they'll do is they'll run it across different jurisdictions within the same country. For example, bankers are under one type of regulatory structure, securities industry is under another type, money service business is under another type. So it's very easy to move it from banking to broker-dealer, securities firm, advisor, personal banker, getting through all of these different folks, and it's still within the same country, but it's a lot harder to find. One really good case that's an example of that is the Bernie Madoff case. Bernie had a lot of experience in the securities industry, and he had a broker-dealer that was under one jurisdiction, and then he had an investment advisory firm that was under a different jurisdiction. So his laundering happened out of that investment advisory firm and not through his broker-dealer, but he had money that could move back and forth between there that we could not catch because it was under two different jurisdictions within the same country.
The determination of beneficial ownership is a core concept of the financial compliance field. Corporate registries are a key source, along with business data providers and open-source intelligence. Recently, regulators have focused considerable scrutiny on the effectiveness of CDD and KYC programs. Financial institutions have to demonstrate they are making rigorous efforts to truly know their customers, and identification of beneficial owners is an essential part of this challenge. You can expect questions about completing and submitting suspicious activity reports or suspicious transaction reports. For example, you'll be given a pattern of customer behavior and asked for the best action to take. Often, the correct response is to file a SAR or STR. You should have a working knowledge of what geographic areas might make a customer more risky for money laundering. It's not necessary to memorize a map of the world and identify every country and its risk, but know there are sources like Transparency International's Corruption Perception Index or the Basel Committee's AML Index that provide country-by-country rankings of AML and corruption risks. Generally, if an area is high risk for corruption, it's also going to be high risk for money laundering and terrorist financing, even fraud and tax evasion. Corrupt countries often have weak compliance regimes, which allows a whole variety of financial crime to flourish. Another area of AML compliance likely to appear on the exam is the proper procedures for customer due diligence during an investigation of suspicious transactions. One important step is to talk to the relationship manager or the person who works directly with the client and find out what they know about the customer and their behavior. Always try to understand the source, origin, and control of the funds. An institution can ask for further documents and details, but should avoid tipping off the customer that they're under investigation or suspected of wrongdoing. So what are some takeaways in preparation for the exam? Understand the definition of money laundering and be able to identify when it's taking place within a series of transactions. Look for funds moved away from an illicit source or destined for an unlawful activity. The ability to determine beneficial ownership and unravel complex corporate structures is very important during customer due diligence and investigations. Expect questions related to concealing beneficial ownership. Some questions ask for the best action in response to a customer's behavior or activity. You'll need to rely on the information you're given about a customer to conduct an abbreviated version of the key steps of AML compliance. Assess their risk, create a profile, and compare their expected and actual activity. Finally, the 3 stages of money laundering are a useful way to frame the process of laundering funds and can help to identify suspicious activity.